You debit your
Because we
inventory
purchase.
because you purchase, right? Purchase from a supplier, so your inventory increases, and then you create your accounts payable of $10,000. All right. So on the November 3rd, this would be your journal entries. Then, all right, on November 10, which is November 10, all right, when you purchase on November 3rd and you make payment on November 10, all right, computer pays the full amount due to PC product, prepare the journal entries. So when you pay on the November of 10, is it within the discount period or after discount period?
Within the discount period.
November 3rd, and then you make payment on November 10. So it's still within the 10 days period. So when you have the 10 days period, what is your discount?
2%.
2%. So means that when you make payment, all right, will you pay 10,000? No, you will pay less because you are given a 2% discount because you make payment within 10 days. So when you have that, means that you're going to debit your accounts payable because you reduce, because just now you create 10,000 accounts payable, right? So you're going to you're going to debit your accounts payable 10,000, but the payment that you make cash is not 10,000. You only make payment of 9,800. Why 9,800? Because you receive a discount of 200. So if total this one is 10,000, but you only pay 9,800. The different 200 is a discount that you take. Right, so discount here is credit because discount here is kind of a revenue or income to the company. So whenever you have a discount income, right, there are the two types of discount. One is discount revenue and the other one is discount expense. So revenue means that whenever you receive discount, it's an income to you. So that's why it's credited. Yeah. But later you see that if you give discount, it's an expense, so you're going to debit the discount income. Yeah. So here, is it clear why you record at 10,000 and then you only pay cash of 9,800? So
Yes,
the
madam.
difference is your 200. Yeah, the discount. Okay. Reduced cost of goods sold. Now your goods sold is now 9,800. Right. Now assume that Computer City waited until December 3rd to pay the full amount. So December 3rd, when you first purchase is November 3rd, you make payment on December 3rd, which is within 30 days. So will you receive a discount? No. Why? Because that is more than 10 days. So because of that, there's no more discount. So when you make payment, you have to pay full $10,000. Okay? Right, next is that when there's a returns of unsatisfactory merchandise, right? So on November 9, Computer City returned 500 of unsatisfactory merchandise purchased from PC product on credit terms of 210 net 30. The purchase was originally recorded at net cost. Prepare the entry for Computer City. So remember that this one, remember there are two types when you record at net cost or you record at gross amount. So it doesn't matter here if you were to record that at gross. Let me see, do this. No, they don't show. Okay, the difference is that, all right, so what means that here is what we call a purchase returns. Why? Because you purchase from the company PC products and now you return the goods. So that's a purchase returns. So remember, Computer City is your company. You return the goods to your accounts payable. So 210 net 30, the value is 500. So if you record at cost, so it means that you're going to debit your accounts payable 500 and credit your inventory 500. Right? Why here is 490? Because they are using the net cost. So we do not use net cost, we use gross. So we are going to record at gross 500 and inventory credit 500. Why you debit account payable? Because your account payable reduces because you return the goods to the supplier, and inventory is also credited because inventory reduces because you return the goods to the supplier. Right? So and then we also have this when we have purchases we have a transportation cost. So transportation cost related to the acquisition of asset are part of the cost of the asset being acquired. So it means that if you purchase your inventory and there's a transportation cost, so the cost will be added together to the inventory. So that will be part of the cost of the asset. Transaction related to sales, here it shows you that you have a revenue, sales minus sales returns and allowances. Alright, similarly, when you have a sales return, means that you make a sales, then there's a returns. Alright, so these returns and sales allowance, so you're talking about sales. Just now it was purchases, right, minus purchase returns. But here we have sales return and allowance will be deducted directly from the sales account. So from here, you have sales minus sales return. You also have a sales discount. What is a sales discount? Means that, for example, you give discount to your customer, right? So that will be deducted from the sales amount. So now you have a net sales. Right, credit terms and merchandise returns affect the amount of revenue earned by the seller. Right, example here, you have sales. Computer City sold 2,000 of merchandise to Highlander Park. Credit terms 210 net 30. Computer City paid 1,200 for the merchandise. So it means that the 2,000 is the selling price, but 1,200 is the cost of the goods sold. Right, so you're using perpetual, so there are two entries that you must make. The first one is to record the sales at 2,000. So you're going to receive from your receivable, your customer 2,000, and credit your sales 2,000, right? But then you also have to record the cost of goods sold, which is 1,200, and credit your inventory of the same amount. So this is to record the sales. Right, under perpetual, you have two records. One is on the selling price, the other one is at cost. Are you
So
okay?
why the date is different, Doctor?
Because this one is different from what?
Because the sale is go on 3rd November, right? So the original paid at the journal 2 November.
Oh, 2nd November. All right. It should be 3rd November also.
Oh, okay.
Yeah, it should be 3rd November. I never realized that error before. All right. Okay. I don't know why they have two different dates there. Okay, it should be on the same date. You record the same date. All right, when you have sales returns, remember that sales is on the credit side, right? Whenever you have sales, is on the credit side. So whenever you have sales returns, it will be on the debit side. Why? Because it's a contra account. So when you say contra account, it's always on the contra. I mean that it's opposite of the main item. All right. So when you have sales returns and allowance, for example here, Highlander Pub returned 1,000 of unsatisfactory merchandise to Computer City. All right, and then Computer City cost for this merchandise was 600. Again, when you use perpetual, there are two entries that you have to use. All right, first is record the sales, return, and allowance. All right, so this one is at the price here is 1,000. Right, so you debit your sales, return, and allowance, credit your accounts receivable. Sales return allowance debit because it's a contra account, it's contra revenue, contra to the sales account, and account receivable is credited. All right, can you tell me why you credit your accounts receivable when there's a sales returns? Anyone? Why there's a credit on the accounts receivable when there's a sales returns?
Because receivables means the purchaser should pay us, but when he returned, there is no need to pay the full amount. So that means that it should be credited from the receivables.
Yeah,
Therefore, it should be
now
deducted from receivables.
the amount due from your receivable now reduces by 1,000.
Absolutely.
Yeah, it reduces by 1,000. So because why? There's a returns of the sales. All right, but at the same time, you also have to record your inventory. All right, why inventory debit? Because when sales return, all right, inventory come back to the business. Right, so now inventory increases again by 600, which is the cost, and you credit your cost of goods sold. So again, it's a contra transaction. If you make a sales, you debit your COGS, credit your inventory. But when there's a sales return, you debit your inventory, credit your cost of goods sold. Okay. All right. Similarly, when you have a sales discount, right? What's the difference between sales returns and allowance? Sales returns, it means that you return the goods, or sometimes you just allowances is given for the returns. Yeah. But sales discount is given a discount for the payment. Right? Where you make payment, if you make payment, for example, within the credit period, then there's a sales discount. So we are talking about you give discount to your customer. When you make sales, for example, you say that, okay, I give you 210 net 30. Right, so when when the customer make payment within 10 days, all right, receive full payment, which is prepare the journal entry. So remember that here it says that less the November 5th returns, right? So you have to go back, right? How much is the full payment? Right, first when you make sales, it was 2,000. All right, then there's a return of 1,000, so the balance now is 1,000. So when there's a 1,000 balance, but because you are given 210 net 30 when you first purchase, remember? So it means that 2,000 minus 1,000 sales return, you have 1,000 balance. But because you pay within 10 days, you are given 2% discount. So from 1,000, you don't have to pay 1,000, you only receive. In this case, sorry, it's not pay, it's a receive. You're going to receive from your customer of 980 only. Why? Because there's a sales discount of 20, right? But you're going to credit your account receivable, the balance, which is the 1,000, which is credited in your accounts receivable, right? So this shows you on the sales side, right? In the previous, we go into the purchases, and now we are looking at the sales discount, right, on the sales side. Delivery costs incurred by seller are debited to delivery expense. So the difference between when you purchase, right, your transportation cost will be added to the cost of the asset or the inventory. But when you make sales, all right, the delivery expenditure will be part of operating expense. So you do not add your delivery expenditure into the sales. Yeah. So it will be your operating expenses. So there's a difference between transportation cost, which is the cost incurred for purchasing the item, but delivery expenses when you deliver to your customer. So that delivery expenses is an operating expense. So you are going to open up a delivery expense account, right? All right. So and then we have this financial analysis related to your inventory, right? Net sales tells you the trends over time. Compare store sales, and then you want to look at how much you make sales per square foot, for example. Yeah. A gross profit margin is what we have gross profit over net sales. It tells you how much profit is made for each of your sales. Okay. Ethics, fraud, and corporate governance. Sales discounts and allowances are contra revenue accounts. Sales discount and allowances reduce your gross sales. As such, net income will be incorrect if discounts and allowances are not properly recorded. So in other words, it means that whenever there's a sales discounts or allowances, it has to be recorded and it has to be reflected to your net sales. Yeah, because your sales discounts, and whenever there's a sales return, for example, so that reduces your sales and it has to be shown correctly. The pressure brought to bear on subordinates to implement fraud schemes developed by top management can often be intense. Top management can threaten employees with termination if they fail to participate in the fraud. Unfortunately, employees who acquiesce to such pressure face tremendous legal risk. All right, so there's always an issue of your ethics where the management want to show a good presentation, for example, want to show a good profit, good sales to the for example, in this case, you're talking about the external, yeah. So in order for them to show that, so sometimes they do not want them to record the sales discounts or to show all the allowances given, right? But this is wrong, right? It involves ethics, and but sometimes employees are pressured by the top management. So these are the dilemma that we normally have to come across, and we have to, right, not to tolerate with this kind of ethical issues, right? So that covers your chapter 6. So in order for you to better understand this chapter 6, let's look into your tutorial question that are given in the Google Classroom. So let's do this together. So I hope that we can learn. What's the time now? Right, we can learn together of what the topics. Okay, are you ready? You need your pen, you need a paper, you need your calculator. Okay, I will do it like this. Right, this question is actually in your Google Classroom. Right, can you see my slide now? Not my slide, my,
Yes, madam.
right? I purposely do it side by side with my Excel so that I can show you how to do the computation. Is that okay?
Okay.
Right. So once you do this, all right, you must remember the formula, right? So the first formula that you must know is that, let me write it down here. The first one is that you have sales, and then minus COGS equals to gross profit, right? And then minus expenditure, expenses, then you will have your net income. Can you see this clearly?
Yes, doctor. Yes, yes,
Okay.
we can see.
So, all right, now you are given this, right? Berg Tooling reports net sales of 325,000, gross profit of 175,000, and net income of 15,000. What the company cost of goods sold, right? So what happened is that you are given this information. Okay, so you plug in the information. So in order for you to do this question, you must know the formula, right? You know that you are given sales. How much is the net sales? 325,000. This is too much. Just yeah. Right, you're given 325, and then the gross profit is 175,000. Okay, so what you have to do is that you have to look for the COGS. Anyone can tell me what would be your COGS? So you need your calculator, yeah?
135,000.
Yeah, so that's it has to be 150. How do you get that?
I got 325,000 minus gross profit minus net income. It will be equal to COGS.
Sales minus gross profit.
They give you the net income here is 15,000. Okay, but I want to look for COGS. Do I need to use my net income? If my sales is 325, right, and gross profit is 175, what will be my COGS?
Ma'am, B part.
B, how do you get B?
Ma'am, sales minus gross profit.
Yeah, so you just plus, right? You just work backwards.
150,000.
Yeah, you only take that 150,000 to be your COGS. You do not take your net income because your net income is you need these expenses. So in order for you to compute COGS, cost of goods sold, you do not need your net income information. Sometimes information is provided just to make you
Confused.
more confused.
All
right.
Okay, I was confused. Thank you.
Okay, so is that clear? Is everyone clear on this question?
Yes, ma'am.
Yes,
All right. We'll do a lot more, all right? When you go along, do a lot more question, then you should be able to understand better, all right? Next is which of the following should not, all right? So when you look into your multiple choice question, careful with the term not, for example, yeah? Which one should not be classified as inventory in the balance sheet of a large automobile dealership, right? So we're talking about inventory, right? It has to be mean that something that you buy and sell to make profit. Right? So you're talking about the company is a automobile dealership. So understand what is a company automobile dealership do? What do
Ma'am,
they
B
buy
part.
and sell? Hmm?
Is it
What do you
D
buy
part?
and sell? Huh?
D part.
No, I ask you first. All right, not the answer yet. Not the answer. I just want you to understand what is an automobile dealership do. They buy and sell. What do they
It's
buy
a
and sell?
Ma'am, sale and service.
cars.
Sale
Car,
and service
right?
of truck.
Because motor vehicles, yeah, they could be trucks, it could be any motor vehicles, yeah. So these are your inventory. So the question asks what should not be classified as inventory, right? So these should be anything that is not inventory will be the answer. All right. So if I were in the automobile dealership, would pickup trucks offered for sale is an inventory?
Yes.
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 All right. So the answer, why am I not? Okay. So that is not the answer because the question wants not inventory. Yeah. So you can cancel out this thing. The B is used cars taken in trade and offered for sale on the company's used car lot.
That is also inventory.
That is also an inventory because the company is a company automobile dealer. So they buy used car, right? And then they sell, right? So that is an inventory. C, we have spark plugs, oil filters, and other parts which are intended for use by the service department in repairing and servicing customer cars. Is this an inventory for this automobile dealership?
I think this is not.
This is not. So maybe C, all right? But look at D. Company cars provided to specific company executive for their personal use. Is this an inventory?
No, ma'am.
It's
Right?
not.
It's not.
D
So
part is
now
a
you are
personal
not
use.
sure whether your answer is C or D. So which one would be the most relevant answer? Not inventory.
D.
It has to be D. Yeah, it has to be D because if you have cars that is used for your company purpose, company secretary, so it means that this is not for buy and sell, right? You may be
Oh, I
purchased, but
see.
not for sales,
Mm-hmm.
right? It's for the usage of the executive. So in that case, this is not your inventory. But this C, all right, it looks like not inventory, but it's used for the purpose of the cars that is to be repaired and serviced, right? So this could also be inventory. Of course, maybe it's not, but looking at C and D, D is a more a better answer, right? So when you do multiple choice question, you really have to read every items, right, and make the best decision. Okay, right. Okay, now we say that the purchasing agent of Superb Service Company wants to know the dollar amount of inventory purchase on account during the year from a particular supplier. Right, so this one I showed you in the beginning just now. Information can be found most easily in superb service. So superb service is the company. So if the company wants to know about a particular supplier, supplier is your accounts payable. Where would you find the information from? Number A is the inventory subsidiary ledger. B, accounts payable control account. C, inventory control account. And D, accounts payable subsidiary ledger. So if you want to cancel out first, which one you want to cancel? Which one? Definitely is
C.
not answer. C.
C is the answer, I guess.
C, no. Okay, what about A? Because what you want to know now? You want to know a particular supplier. So when talk about supplier, it's your accounts payable. So if it's accounts payable, you have B and D. So definitely A and C is out. Right? So A and C is no longer your answer.
Then
So
D.
now you have to decide whether is it controlling account or a subsidiary ledger. Right? Control account means that a subsidiary ledger is every, in this case, accounts payable. Right? Every accounts payable will have an account. So that is a subsidiary ledger. The control account is the total of all your subsidiary ledger. So the answer for this must be D, which is the payable subsidiary ledger, because you want to know a particular supplier. From the control account, you will not be able to identify individual supplier or your accounts payable. The answer must be subsidiary ledger. Right? So this one is already in the slide that I showed you earlier. You can refer to that again. Okay. Okay, next is the interesting question. We have net sales of 3,750,000 or 3.75 million. Net income 375,000, gross profit of 900. So the answer is, the format is similar, right, to this, right, where you are given, in this case, here, you are given, let's do this again. See, you're given sales of 3.75 million. Net income is 375,000. And then you're given gross profit. Okay, anyone would like to test again? What would be your COGS?
Then D part.
D, which is 2850. How you get 2850? 3750 minus
Sales minus this gross profit.
you should get this, right? Which is D. So are you clear about how to compute this COGS given the information? Given partial information,
Yes, doctor.
right? You should be able to compute your COGS. Alright. Okay, next. Under perpetual inventory system, which journal entry indicate a purchase of merchandise? When you purchase a merchandise, right, what would be your journal entry? A, debit your inventory, credit your cash. So in this case, you purchase on cash. B, debit your purchases, credit your cash. C, debit COGS, credit inventory. And D, debit inventory, credit COGS. If you are not sure, you may want to cancel out which question or answer which is totally wrong. Which one is wrong? Definitely wrong, not the answer. Perpetual. Which one? Which one is not the answer? Cancel out.
D is not the answer. It should be
Again,
clear.
D?
D1. D1, yeah.
D, because you debit inventory, credit COGS. So why you say that this is not the answer?
Because debit inventory, credit cost of goods sold. Means we have cost of goods sold.
COGS is only when you make sales, right?
Yeah,
But one
it's
is
why
where you
because
make
we have.
purchases. So you cancel out D. Anything
Yeah.
else that you want to cancel then? I cancel C because again COGS is there. COGS is not when you purchase. So I will cancel C also. So now I have A and B. Which one I will cancel out? Which one is wrong? A or B? Inventory perpetual. Where you purchase. Which one?
I think B is wrong.
A.
B is wrong because do you have purchase
Because
account? Purchases is under which system? You may not remember, right? Inventory purchases here is under periodic. All right. So when you have a periodic, you're going to debit purchases, credit cash. But under perpetual, you're going to debit your inventory and credit your cash. Can you remember that? You want to put the note on why the answer is wrong, right? Because if you understand why it's wrong, that also helps you to understand the topic better. Right, COGS is nothing to do with purchases. So that's why C and D is out. And then you are left with A and B. Under perpetual, you open inventory or purchases. The answer is inventory. So the answer should be A. Right? Okay. To further understand perpetual system, A, in a perpetual system, merchandising transactions are recorded as they occur. Right or wrong? Could be the answer. No effort is made to record the COGS until year end. Is that right or wrong?
wrong.
Wrong. Because why? When do you record
Because
your
we
COGS? Under perpetual? When you record your COGS? Whenever there's a sales, right? Whenever there's a sales return, for example, you will record COGS under perpetual. Alright, and then entries are made in the COGS whenever merchandise is purchased, right or wrong? When it's purchased or sold, right or wrong, this statement? COGS when merchandise is purchased or sold. Tell me true or false the statement.
maybe it's right.
Why?
Because the cost of good sold account we recorded when the have a purchasing or the sold of the inventory.
When you purchase, you record cost of goods sold. Do you record that when you make a purchase? Right? When I say that cost of goods sold is only when goods are sold, not when you purchase. So this statement is halfly correct only. Why? Because it's only when it's sold, not when it's purchased. So because it's only one right, so it's wrong. Right? If I say that it's only is sold, that is correct. But it's purchased or sold, that's wrong. Because we only record COGS when goods are sold. So C is out. D, the need for overtaking physical is eliminated. Even though you do have a perpetual inventory, right, you still need to do a physical stock take in order to compare your physical inventory with your values in the account. So D is wrong. So which one is the answer then? A, B, C, D.
A A, Doctor.
It has to be A.
A is correct.
Yeah, A is correct. B is wrong because you always record. C is wrong because you have the purchase here. And D because it's not eliminated. You still need to do a physical stock take even though you do a perpetual accounting system.
I guess the reason was in perpetual accounting system, it is for large companies and the transactions or the goods may have barcodes. So when it enters, automatically it's recorded. Isn't it?
Yes. Okay. All right. In a perpetual inventory system, 2 entries usually are made to record each sales transaction. The purpose of these entries are best described as follows. One entry to recognize sales revenue, the other to recognize cost of goods sold. B, one entry to record purchase of the merchandise, the other to record sale. Is that right? Right. 2 entries are made when you make sales, right? So why do you have to do 2 entries? The answer is A. One is to recognize sales, the other one is to recognize COGS. Right, so this one B, why you need to record? Because they say a purchase. No, we are not talking about purchases. We are talking about sales now. C, one entry to record cost of goods sold. The other one is to reduce the balance inventory. No, this one is the same entry, COGS and inventory. One entry to update general ledger, the other update subsidiary. No, it's nothing to do with your accounts receivable in detail. Yeah, so the answer will be A. Right, one is to recognize the sales revenue, the other one is to recognize the cost of goods sold. And number 60, Hicksville department store use a perpetual inventory system. At year end, the balance in the inventory control account is 1.2 million. Assuming that the inventory records have been maintained properly, a year-end physical inventory, A, is unnecessary. B is needed to establish the ending inventory as 1.2 million. In the inventory control represent the beginning inventory. Is this beginning? No, it's still a closing inventory. Probably indicate more than 1.2 million, probably indicate less than 2 million. So which one is the correct answer? Anyone? Right? So the answer here means that under perpetual, you already know that, right, your at year end, the balance of your inventory account is 1.2 million. Right? And then it says that if you maintain that, right, a physical inventory at the year end, is it unnecessary? No. You still need to do a physical inventory. So A is wrong. Right? B, is it 1.2 is the opening beginning inventory? No. 1.2 million is at the end of the year, so it means that that is the closing inventory. So B is wrong. Would you have your inventory more than 1.2 million? Your physical count is more than your account? Not unlikely. Yeah, it's unlikely to have that. But can you have less than 1.2? Yes. Because why? Because of the shrinkage. Right? So the answer would be D. Right. Okay, let's look into this. This one is a periodic inventory system. What would be your COGS under periodic? Anyone? How to compute COGS? All right. So for periodic, right, you have to use this formula, right? In order for you to compute COGS, is the opening inventory plus your purchases, then you get your goods available for sale, or what I call gas, right? And then minus your closing inventory, then you will compute your COGS. So just plug in the information. What is your opening inventory? The beginning inventory is 11 to 100. Your purchases made during the year is 32 to 100. So how much is your closing? I mean the goods available for sales, right? So your goods available for sale is 43,400, and your closing inventory is 9,800. So it means that if your gas is 43,400, your COGS, then you compute, right? So that's how you compute your COGS. So your COGS will only be your So your COGS will be 33,600. So given information, you just plug in that information in order for you to compute what is your COGS. Again, for periodic, all right, opening inventory plus your purchases, you will get your goods available for sale, and minus your closing inventory, then this is your goods sold during the year, right? So can you get the answer, 33,600?
Doctor, can you repeat what is a gas?
Gas is goods available for sale, right? Right. So what happened is that, right? Why is it called goods available for sale? You have inventory of 11,000 in the beginning of the period, and during the year you have purchases 32,200. So it means that your opening inventory plus purchases made during the year, you should have a goods available for sale of 43,400, right? Does that make sense?
Yes, yes.
Yes,
Right.
yes, doctor.
So if you have goods available for sale 43,400, but you do a stock take. When you do a stock take, you only see that, I only have 9,800. Where are the balance of the goods? So the goods which are not there must be sold. So that's why you get the closing figure here is what is missing, means that those are goods which you have sold. So this is what we call cost of goods sold. Logically, does that make sense?
Yes.
Yeah. So remember that periodic is for small companies, so they don't have to monitor their inventory much, right? So, but they have to do a stock take so that they know how much is the closing inventory, and then, all right, they can compute. Oh, my COGS for the year is the difference between goods available and the closing stock. Yeah. All right. So now the next question is, what is your gross profit? What is a gross profit? You tell me. How to compute your gross profit? Anyone?
It's expensive.
No. What is a gross profit?
Gross per sales minus revenue minus sales.
Again?
Gas minus COGS.
COGS. Right? Sales minus COGS is your gross profit. Have you done this before? Yes, you have done it. All right, at the top. See? Sales minus COGS is your gross profit. All right, the difference is that, right, in the perpetual, the COGS is there. But under periodic, you have to look for the COGS. You have to find the COGS. So sales here given, how much is your sales? 43,400. That is your sales. Yeah. Right? Your COGS is 33,600. So what would be the difference is your profit. So So if you can make sales of 43,400, right, which is also the goods available for sale, but you still have a closing balance, yeah? So if you make sales of 43.4 and your cost of goods sold is 33.6, it means that your gross profit is 9,800. Do you have that answer? Yes. Tak nak. Tak boleh nak urut tak ni. Tolong urutkan. Garlic. Cheese. Dua-dua. Nak. Kongsi lah. Okay. Alright. Clear. Okay. Now, alright, I want you to do. Okay, let's do this together. You want to do this together or you want to do it on your own?
Together, doctor.
Huh?
Together, please.
Right. So let's do this together. Okay. What we have is that we have the transaction. I have it somewhere. Okay. Yeah. Do this here. Stupid. Okay. I can enlarge this. So can you see my Excel only?
Yes, ma'am.
Okay. Can you see this clearly? Right. So let's do it on this side. Right, we are going to do the transaction here. And then we are going to do the accounts here and whether to debit or to credit. Okay. Okay. So let's look at the first transaction. Purchase merchandise on June 1st. All right. So you put in the date June 1st. Purchase merchandise from Martin Company for 900 with the terms 210 net 30. So what will be your journal entries then? When you purchase on account from Martin Company 900 terms 210 net 30. So how are you going to record this? Is that you're going to debit. So this one is using perpetual inventory. So when you make purchases, what are the entries? You're going to debit your inventory and credit your accounts payable. How much? 900 and 900. You can do it like that. All right. Are you following?
Yes, doctor.
Okay. So on the June 1st, when you purchase on account from Martin, all right. So Martin here, I just put a name Martin here so that you don't get confused. Right. So you purchase from Martin on June 1st, amount of 900, but you are given 210 net 30. And June 2nd, you return 100 of the merchandise to Martin Company. So what is that? What is this transaction that you call? You first purchase, then you return. What is it called then?
Return stock.
Returns. What kind of returns? Is it a purchase return or a sales return?
Sales return. Yeah, sales return. Sorry.
Sales return. Are you sure you purchase or you from Martin? You purchase or you sell?
So because I bought from Martin and then I'm returning back.
So
It's sales return.
sales return. You bought. You purchased from Martin.
Yes.
So when you return, it's a sales return.
That's
It's
correct.
not possible then.
No, it's sales return. Or am I wrong?
Yeah, you are wrong. All right.
Okay.
When you first purchase, we call it as a purchases, right? June 2nd. So when you return is a is a purchase return.
Okay.
Right? So, but sorry, let me see. You are going to debit your accounts payable, but you don't have a purchase return. You're going to credit your inventory, right? Why? Because this one is under perpetual, so means that you're going to debit your accounts payable and credit your inventory. How much is it? 100. Yeah, so you're going to debit your accounts payable 100, so means that the amount due from your accounts payable is less by 100, and your inventory is also reduced because you return inventory to your to Mati, right, to your supplier. Okay, if you're not sure, let me check. Where is it? Where is the here? Right, just double check on your sales return. You got purchase returns, right? You debit your accounts payable, credit your inventory. So that's why the adjustment that we have just done just now. Right? So that would be the entry when you have a returns under perpetual. So remember that this one is a perpetual. All right, and then what happened? On June 4th, you purchase merchandise. Purchase from Elizabeth Company 700, term 310, net 30. So when is that? It's on the 4th of June. Right, you purchase means that you're going to debit your inventory, right, and then you're going to credit your purchase from Elizabeth. So accounts payable, and this one is from Elizabeth. How much is it? 700. 700 and 700. Debit inventory because you make a purchases. All right, and then June 6th, what happened to on June 6th? You paid the amount owed to Martin Company, right? Paid amount owed to Martin Company. So how much is the money? So means that you're going to debit your accounts. Just copy, command C, Martin. How much I'm going to pay cash out? Okay. So there's you have to do some computation here. So remember that first, when you first purchase, right, where's your Martin? You credit 900, right? So account Martin, you credit 900. You credit 900, and then there's a returns of 100. So minus 100. Okay, so and then so the balance due is 800. But when you make payment on 6th of June, right? When you first purchased, it was 1st of June, you are given 10 days. So 6th of June is still within the discount period. So if you pay within discount period, what would be your discount?
It's 2%.
2%. Right? So this is the amount balance. So the discount is 2%. 0.02 times by top. Point 0.02 times by 800. So this is the discount 16. So how much can I have to pay? The difference, right? So instead of I pay 800, the full amount, but because I pay within the discount period, I only have to pay 784. So that 784 is my payment. But I'm going to debit Martin of 800 because that's the amount due to Martin. But what happened is that, remember that command X, I will just put it here on the side. Remember that there's a discount of 16, so I put 16 here. This one is the purchase discount, right? So why is it discount? Because it's an income to me, because I receive the discount because I make payment. So that's why it's a credit side. All right, if you total 784 and 16, you should get 800. So it's debit side 800 and the credit side is also 800 ringgit. So far so good. Are you okay? So the initially purchase, that was the first purchase, and then there's the returns, and the balance is 800. So from that balance, you have a 2% discount, and you only pay 784. So that will be the entries for your payment of the amount due. Yeah. So the next one, you paid return 50 of the merchandise purchased from Elizabeth. All right, again, this is the another transaction. It's the same nature, but it's just that now the purchase return is from Elizabeth. So what would be your entry when there's a purchase return?
It's 9 o'clock.
Anyone? You have done this purchase return from Martin. Right, this one is when you purchase from
Purchase return.
Right, so what is your entry for this purchase return 50 of merchandise purchased from Elizabeth? What will be your journal entries?
Account payable.
All right, debit your accounts payable 50, credit
Inventory.
your inventory 50. Why? Because now your amount payable reduced by 50 because you return the goods, and you also credit your inventory because the goods now return, so your inventory also reduces. So when is that? That is on the June 8th, right? So June 8th, you will have debit your, not debit, accounts payable and command C, command V, but accounts payable here is to Elizabeth. Right, how much? 50 and 50. So when there's a returns, all right, this is your entry. Right, so let's do this. And then you have sold all the merchandise on hand from Martin Company for 1060 and collected 8% sales tax. So in this case, you don't have to worry about this sales tax, right? So you don't have to include this. We just record sold all the merchandise on hand from the Martin Company for 1060. And remember that under perpetual, whenever there's a sales, there are two entries. One is to record the sales, the other one is to record the cost of goods sold. So the sales is 1060. So what's that? When is that? June 12. So the entry for June 12 is, the first one is going to be sales on cash, is it? And collected. This one is all cash sales, yeah. So you make a cash, you receive cash of 1060 from the sales, right? 1060. But then you have to record your COGS and you also have to record your inventory. So what is your inventory from Martin left? Right, what's the cost of the inventory? The cost of the inventory is 800. This one is Martin, right? So remember that you first purchased 900 from Martin, then you return 100, so the balance is 800. So you're going to debit your COGS 800 here, and here is also 800. Right? So this one is to record on the sales on the goods that you first purchased from Martin. So Martin, first you purchase 900, and then you have a returns. Yeah, returns of 100. Here Martin, so easy for you to refer to. Right, and then so it means that the balance 800 is your cost of goods sold. And finally, we have paid the amount owed to Elizabeth in full. So here is June 16. Elizabeth, when you first purchase from Elizabeth, you have 310 net 30. What does it mean by 310 net 30?
Discount 3% in 10,
You pay
10
within
days.
10 days.
So when do you actually pay to Elizabeth? Is it within 10 days or after 10 days?
No,
After
after.
10.
After. So is there a discount?
No.
No,
No.
discount, right? But remember that Elizabeth, you have a purchase returns here. So you have to take into account how much is the balance owed from Elizabeth, right? So it means that you're going to make payment to your, where is it? This one. Let me just copy this command C. Can copy all. Right, when is that? This is on the 16th, right? Which is 16th of June. Accounts payable, how much you have to pay Martin? In this case, you pay Elizabeth. Right? So how much you have to pay? Okay, let's see. Elizabeth. Initially, you purchase from Elizabeth. What is Elizabeth? 700. And then you return 50. So 700. And then you minus 50. So the balance is 650. Right? So there's no discount, but you're going to pay in full 650. Right? So there's no discount for this. All right. Does that make sense? Understand the transaction? Right, so this is a normal requirement for you to do is to journalize the entries. Journalize the transactions. Okay, so when you are required to journalize the transaction, you have to show me the debit and the credit, which accounts to be debited, which accounts to be credited. If right, you have wrongly stated inventory to be credited, accounts payable to be debited, is wrong. Right, it has to be correct, which account to be debited and which account to be credited. Right, and you also have to do some workings on to know how much is the balance amount due, especially if there is a returns on the purchases. Okay, so it's already 9 o'clock. Let's take a break for a few minutes and then we come back